Okay, how does investment property reduce your tax? All right, on the left-hand side here, we've got the tax brackets at the moment. No one pays tax on the first 18,000, then you pay 19 cents on the dollar on every dollar you earn between 18,245 and so on, right? If you earn about 100 grand a year, you're paying about 25 grand tax, okay? Now let's say we own this investment property up here. It's worth 500,000. It's got a mortgage of 450 at 3.5% interest rate. It rents for 500 bucks a week or 26 grand a year. That 26 grand goes on top, okay? And that's actually taxable income. So at this point in time, you would have a tax bill, not a tax return, because you didn't pay any tax on the rent. But then, of course, we can reduce all the expenses. These are tax deductions that reduce our taxable income. The loan interest, the council rate, the rental management fees, insurances, the maintenance. Okay, these are what we call cash deductions. $21,738 comes off the top. We've earned 26 and we've lost 22, so. Okay, at this point in time, we still have a tax bill because we had more money coming in than going out. But enter the secret weapon of property investing, which is this depreciation, which is a non-paper deduction when you're spending your real money, but it does reduce our taxable income. So now our new taxable income is 89,000, but we paid tax on 100 grand. So we've paid too much tax. We're entitled to a return from the government. That's then calculated as follows: 32.5 cents in the dollar. So we get 3.5 grand back in the tax return. Now, in reality, what is the cash flow of this property? In reality, it's getting 26 grand in rent and 3.5 grand in tax return. In real cash in your bank account, $29,489. Real expenses going out the door, only $21,738. This property is 7.5 grand positive cash flow after tax. You have got yourself a pay rise by buying this property. Okay. Now, this is passive income. Really important lesson here. Know the difference between passive income and job income. Job income is earned by jumping into that hamster wheel. You're the human in the hamster wheel, right? And that hamster wheel is attached to a money printing machine. And if you're in the machine and you're running around, it prints money, right? That's your paycheck. The moment you get out of the machine and stop working, it stops printing money, okay? But there are other things you can buy that will print money for you without you having to be in them, okay? And those things produce what's called passive income. Passive income is money you get without working. Now, if you had a passive income of 7.5 grand a year on top of your job income, what could that 7.5 grand a year pay for? It could pay for an annual family holiday. And every year that passive income is going to go up as the rent climbs. So those holidays are going to get better. It could pay for the lease on a car. Okay. And this is what you got to realize is passive income is for fun. Work income is to be respected because you work so bloody hard for it. You've got to not waste it. We'll talk about that in a minute. Okay. A bit more. Well, $149 a week. So you could lease a car, you could take an annual family holiday. And eventually, as that grows and you've got several properties all add up together, eventually that passive income will overtake your salary and then you can retire. Not only can you retire forever and you can leave that passive income to your kids after you die.